In this video, I'm going to show you the raw numbers of using whole life contract and real estate together. When used in tandem, how you will have more wealth compared to buying real estate using a savings account. To preface this is a real life example. The numbers may vary, but the concept is the same. I invest into syndication real estate as a passive investor, and this is how I use my policy. That being said, let's dive into the numbers. First, let's look at the math if we just put our money into a savings account without investing in real estate. So here I am saving $50,000 a year going into my savings account, and I am earning a 2% interest. And we can see what our interest is and what it adds up to be. In today's environment, you can likely find something higher than 2%. But 2% is what my bank currently is at. And this number was at 0.1% for more than the last 5 years previously. So I think this is a fair number to use, especially not knowing what the future will be. So after 10 years of compounding, you can see the total amount is $559,007.69. Now let's look at the numbers for the real estate deal. I invested into a small mobile home park that was under contract for $400K with a 6% cap rate with an average annual return of over 5 years of 37% after the sale, with an average of 9.44 cash on cash return. Here are the cash flow numbers for the investment. In year one, there was a 3.36% of $2,017 of the highest return on year four of $8,362 at 14%. The total cash flow received over the 5 years was $28,359. The funds received after the sale of a property at the end of the fifth year was approximately $144K. The total funds received, including my initial contribution, was roughly $172K. So I had two options. Option number one, I could have used a savings account to store my capital and then invest in the real estate deal. Or option two, use my whole life policy and invest in the real estate deal. I chose option two, but let's look at what the numbers would have been with option one first. So I will use the same interest for the savings account of 2% and use the numbers that I previously showed for the real estate deal. So over a 10-year window, you'll see that I have contributed $50,000 to the savings account using current cash flow and income. This strategy only works if you have cash flow. If you're living paycheck to paycheck and have no savings, no cash flow, or no massive amount of money that is already liquid, then this will not work for you. At year three, you can see here in orange, I took $60,000 from my bank to go invest into the real estate deal, which again, like I mentioned, this is why it's orange, just to emphasize why the number goes from 50 to 100 to 90, because I end up taking 60K, but I also contributed 50K. So it's really like that $10,000 difference. After 10 years, you can see my total savings account value is a little over $480,000. Okay, so that is the savings account. That's after being compounded at 2%. Now, if we look at the real estate deal, like we mentioned before, it is at a total of $172,000, right? We can just see the column, the 60K initially contributed, the cash flow over the next few years, and then when you sell, $84,000, which gives a total of $172,000. So after 10 years, I have a total of $652,000 with the savings account and the real estate deal together. Now, to be fair, I would have to pay $8,057 of taxes if we just use a 20% tax rate. So what you can see here, savings account tax is here in red, is the total tax for the account, which, to be honest, the 20% tax rate is quite generous. What I also did is I added a term cost. There's a $2 million for a 10-year window. It's actually a 30-year term, but we're looking at it in just a 10-year window. At a super preferred rating for a male my age is a cost of $1,225, which gives us a total cost of $12,250, which you can see that I've put it here in red. Red is an expense, green is in money in the bank. Now, I want to be as fair and accurate as possible. So from the deal, I will generate cash flow. So from the cash flow and it being put back into a savings account around 2%, that is a total of $30,022. So essentially taking this cash flow putting it back into the bank account, earning 2%. Cash flow from real estate gives us $30,022. So when I look at all the costs from taxes, term insurance, and also interest, the total after all of that being added and subtracted gives us a total of $662,378. Next, we're going to look at a whole life contract combined with real estate. We're going to contribute $50,000 a year into the whole life policy for the next 10 years. We're going to do that to mimic the savings account example. Note, for you personally, you can do more or less than $50K a year. This is for a specific case study. So you can see after 10 years, I have a total of $575,282. And if you compare that to the savings account, we had a total of $559,000 with no real estate. But the savings account example with real estate, we had a total of $480,288. Remember, the biggest difference is here. In regards to the savings account, we're not taking any money out withdrawing. In the real estate example, we actually took out $60,000, which is why it is less in this example than it is in this example. And in the whole life contract, we are not actually withdrawing any money. We are borrowing against, which I will go into share next. If this is your first time hearing about the concept, we don't withdraw money from a whole life contract like we do from a bank account. Your dollars are used as collateral and the insurance company gives you a loan. By doing so, you get tax advantages, you get to utilize the loan tax-free, and as it grows larger, you can continue to utilize it tax-free as well. This is because the IRS does not classify debt as income, and debt is not taxable. Also, when you borrow, this keeps your funds still in the account growing while you get to use the insurance company's money to go invest into other opportunities. As a real estate investor, here's a familiar analogy. Think of a property that is worth $500K where you could get a HELOC. You borrow from your HELOC for $300K and use it for real estate. The value of your home doesn't go down by $300K. You could still sell your property for $500K. You obviously still have an outstanding loan of $300K though, but the value of your home doesn't change. This is the same concept with whole life insurance. The main difference is your home appreciates and depreciates in value, increasing and increasing your line of credit, and your policy compounds, increasing your line of credit. There are a lot of other differences, but this is a great way to conceptually think about it. So in this example, in year number 3, the policy is worth $128,743. So I have policy value here, and I have policy cash value available here. So what ends up happening is the value of the policy continues to keep going up, which I have them in blue here because they are different than the policy cash value available. So when I borrow $60K in year 3, my policy value does not go down. It stays at $128,743. But here I have taken a $60,000 loan to go ahead and use for real estate. But what does change is my available amount to borrow. The amount I can borrow for another deal at this point in time is now $64,903. And you can see if we actually were to pull up the illustration and look at the numbers, you can see what I have done is I have shown in year 3 income, which is essentially a policy loan at $60,000, and the total cash value available to actually use is aligned, this column here, with the column here of 64,903, 64,903, 116,651, 116,501. So this is a column showing the policy loan, policy available cash value. And this is the column showing, hey, if I don't have a policy loan, this is what my policy value is actually still worth. And again, this is how this works, because in whole life insurance, we're not actually pulling our money out, we're borrowing against this column. So when we borrow against our policy, there is a loan interest rate, just like when you borrow from your HELOC. Most HELOCs at the time of this recording are roughly 9%. To borrow against your life insurance policy, the rates are currently between 5 and 6%. Life insurance loans are some of the cheapest money available right now. In this example, to have our dollar do more than one job and to also get the tax advantages, we are charged 5.7% annually by an insurance company to have control over that $60K to go invest in this mobile home park. So you can see in this ILI, the numbers for the contract are $60,000 of income coming out with a total loan balance of 63,420. So essentially, if I took this number at 60K and I multiplied it by 0.057, 5.7%, it'll give me a $3,420 interest payment. So that's what it's showing at the end of the year, of a total balance of 63,420. Essentially what I did here is I just took these numbers and I transferred them over here so you can see the total loan balance and the total loan balance. This is being charged simple interest for the year, but if you don't pay the interest back, then this becomes compound interest in the wrong direction. So now that we conceptually have an idea of how the policy works, let's go back and take a deeper dive into the numbers. So we know from our real estate deal that our numbers from our cash flow are year one, $2,017, year two, $7,247. And the reason that these are in red is because when I received the cash flow, what I did is I decided to make a policy payment back towards the loan balance and interest. Okay, so I didn't take this cash flow and I didn't pocket it in my bank account like I did with this account. You can see, remember over here on this side, we did cash flow interest from real estate, compounded at 2%, gave us $30,022. I did not do that in this scenario. In this scenario, I took the interest that I made from the cash flow and I paid that back to my policy. So when we look at the very first year of cash flow, you see only a 3.36%, which gives us a total of $2,017 return, which isn't great, especially because by borrowing rate in the policy again is at 5.7%. Ideally, you always want to borrow to get a greater rate of return than what you are borrowing at. But if you know real estate, you know things aren't always the prettiest, especially the first year. The very first year of the mobile home park, we had to stabilize it. So we had to clean up the park, kick out the bad tenants, raise the rents, and bring in a couple mobile homes to fill open lot space, which required time and resources. So I knew the first year wasn't gonna be super sexy. When breaking down the numbers again, year one, I only made $2,017 of cash flow at 3.36%. When I borrowed the $60K from my whole life insurance contract, I was borrowing at 5.7%, which cost me $3,420. I actually had a negative spread on my dollars of about $1,400. But we also have to look at the entire picture. I still had my $60K working for me in the real estate, gaining momentum, while that same $60K was still inside my policy working for me. I have an asset where I'm getting tax advantages. I have a death benefit of $1.7 million that is protecting my family in case something happens to me. And I can write off the loan interest from my policy as well. Also, another huge benefit is life insurance loans are unstructured, which means that you can pay the loan back when you want, however you want, if ever at all. Now, I encourage you to at least pay back the interest, but you don't have to. The reason this is possible is because when you die, the insurance company will just subtract whatever loan balance you have outstanding from your total death benefit, and the rest will go to your beneficiary. All right, so to reiterate, here's what I did. Every time I got a check that came in from cash flow, so from real estate, the 2017 7247, I ended up taking that and paying down the policy loan balance, which essentially kept bringing it down and down and down. And then what ended up happening was when I sold the property's value was a total of $84,017. But there was a total balance still left, loan balance of $50,361 in the insurance contract. And so if we go back and we look at the actual insurance policy, you can see that at this year 8, there was $50,361 of a loan balance that was still in the policy. So when I sold the property and the proceeds came, I then took that money, that $50,000, well, the full 84, and subtracted $50,361 361, which was the remainder of the policy balance. And the total amount was 33,656. So the dollar amounts that I added up together here are the real estate initial contribution. And I thought it was fair. You know, I did the same thing over here on the real estate side, $60,000 of the contribution. I added them up to the total amount. So I'm gonna do the same here on the real estate on the whole life insurance side, take the initial contribution. And then the remainder after all costs from the loan, and then the sale paying off all the policy loan balance, the total proceeds that I have left from the real estate deal is $33,656. So I added the 60,000 plus the 33,656 and got a total of $93,656. So let's take a look at the final numbers and see how this all conceptually worked out, factoring in the loan costs, taxes, term insurance, and see what comes out on top. So in summary, after 10 years in the real estate and savings, had a total of $662,378. And after it is all said and done with the whole life and the real estate, had a total of $668,938, adding up this 93,656 plus this 575,282, which is what is available in my whole life policy, what essentially is available left from after the real estate. So you can see the difference between the two, drumroll, is a whopping $6,560. So you're telling me after all that, after 10 years, I'm only on top $6,500 more? Yep. But let's look at this even deeper. After 10 years, I have a permanent death benefit of $2.8 million and growing versus only $2 million with term. I have $6,500 more of cash. And more importantly, I'm about to show you the numbers to back it up. I now have literally one of the greatest assets on the planet that is getting bigger and better with time. Most people that don't understand this look at the first couple years and say, I have less money than I contributed and I had to borrow to use my own money? So stupid. Why would I do that? I then empathize and tell myself, this is why there is a massive gap between the wealthy and the middle class, because concepts like this around money are not taught or not quite understood. To win and succeed at anything worth it in life, you can't be short-sighted and you must be educated. If you told me you would be successful after buying one property in real estate your first year, you would probably laugh at yourself. If everyone had the long game mindset in general, more people would win. And not just here, but win in business, relationships, health, and finances. But here's how having the long-term mindset and using whole life will help you win. Looking at the numbers at first, whole life isn't sexy. There are startup costs, fees, commissions. You don't have dollar for dollar access. Getting past the early stages is literally the hardest part, just like with anything. And even after 10 years, it is mediocre at best with $6,500 more and $2.8 million of a permanent death benefit. But hey, I would take that overnight any day. But here's the real power as we look at this on a longer term horizon. The average death of a person is age 76. If we look at the total savings I would have in my savings account after year 46, which is age 76, I would have $3.7 million. Even looking at a savings account long term, it looks pretty good. Now, if I look at what I would have in my whole life contract, I would have essentially $7 million. And that is with contributing $800K less into my whole life contract than my savings account. Oh, and don't forget, you love someone or a cause, right? At age 76, you would no longer have your term insurance. You know, the one you paid $1,200 a year for 30 years and got nothing back from it. But by utilizing whole life, I also have almost $10 million to pass to the people I love. So to sum it up, if I were to buy real estate without whole life, I would lose out on almost $10 million of legacy to pass down generationally, miss out on over $3 million of cash flow to buy with other properties. With this, who could you help? How many more properties could you buy? What impact would you make? And who will remember you when you are gone? If real estate investors understood this, every single real estate investor on the planet would get a whole life policy. I spent a massive amount of time making this video, many multiples of hours, to try and provide the best education possible out there for you. Because it takes so much time and energy, there's a reason why there isn't any content out there going into it this in depth. It's so much easier for us as content creators to say, get a policy, be your own bank. And then for people to combat it with, whole life is a scam. Whole life isn't the issue. It's the education around it and how it's sold is the issue. And when done right, its power is unquestionable. I hope you enjoyed this content as I tried to do my absolute best to be as clear and concise with a concept that sometimes can be hard to understand. I would love to hear your thoughts on anything else you would like to see in the comments below. And if you want to talk to someone on the team about getting a policy to set up for you and your family, click the link below in the description.